Hey, welcome back. Alex here. We're figuring this out as we go, which is honestly half the fun. So Friday closed in this weird holding pattern. The AI stuff held up fine, QQQ barely moved, AMD was up 3.5%, but energy just could not get out of its own way even though oil was rallying in the morning. Financials took a real hit, down over 1%. Then overnight the geopolitical backdrop shifted. US tightened the blockade in Hormuz, and Brent just went vertical. We're talking $95 to $100 a barrel now. Futures got punched. S&P down 0.54%, NASDAQ worse at 0.63. But here's the thing that's making Monday morning strange. NVIDIA's up 2.5% in the pre-market. AMD up 3.5%. Amazon up 2%. The AI names are just bid while everything else is in the red. So we've got this classic paradox. Geopolitical pressure, oil shock, futures in the tank, and yet the mega-cap AI infrastructure is trading like none of it matters. Tom, Ray, let's figure out what's really happening here.
Yesterday I tried to return a toaster. Not broken, just too aggressive. It had a bagel optimization mode, which I think is just code for, "We've decided how you like things now." The guy at the counter didn't question it. He just nodded like, "Yeah, appliances have opinions now." Anyway, that's basically the market. Oil wakes up at $100 because a shipping lane gets tight, and everything else is supposed to just adjust its personality around it. AI holding in while energy rips is the same thing. We've decided growth is insulated from physics. Inputs can spike, costs can move. Doesn't matter. The model says productivity fixes it. NVDA's like that toaster. Works great, as long as you accept its version of reality.
Tom, you're returning a toaster because it has an ego. But you're right. The market is just deciding to ignore the physics of the situation. Oil hitting $100 because of a supply choke point, that's the nastiest kind of inflation there is. It's not a sign of a booming economy. It's just a tax on every single person trying to get to work, and it hits the CPI print without adding a dime to anyone's paycheck. It's the total inverse of where we were last Monday when that ceasefire talk cooled everything off. Now the basement is smoldering again. And we have PPI tomorrow, which is usually the second punch in the face after a hot CPI. We're seeing the AI names catch a bid because people are desperate for growth that isn't tied to the price of a barrel. But eventually, the toaster has to plug into the wall, you know?
Yeah. Demand inflation is everyone's doing well. Supply inflation is something broke and now it's your problem. The market's basically saying AI productivity cancels out a $100 input cost, which is a lovely theory. We're about to find out if silicon scales faster than reality.
That's the bet, isn't it? The tape is up next. So Friday was this beautiful little case study in how fast the market's fear dial can turn. We got CPI at 3.3, headline, gas-driven, basically what everybody expected. And the tape just said, fine, I'm moving on. QQQ eked out 14 basis points. Not exactly ripping, right? But here's where it got interesting. Energy got absolutely destroyed. XLE down 68 basis points, even though crude was actually bid in the morning. Why? Because the ceasefire chatter killed the war premium overnight. Suddenly it's not a supply shock anymore. It's just oil, and everybody's looking at demand destruction for refiners. That's the story nobody wants to talk about. Meanwhile, financials cratered, down over a point on yields just drifting lower intraday. Margin squeeze, pure and simple. But semiconductors didn't care. AMD up 3.5, NVDA just on another planet. And silver beat gold, up 101 versus gold flat to slightly negative, which tells you something. It's not pure haven buying on ceasefire day, it's industrial demand coming back. Then overnight, Hormuz tightened. Brent snaps back to 100. Futures are screaming down, S&P minus 54, NASDAQ minus 63. Except NVDA's plus 2.6 pre-market, AMD's up another 3.6, Amazon 2 point. Tom, am I reading this as supply shock beating demand destruction, or are these semis just completely decoupled from the macro tape at this point?
Are we just watching a belief system hold under stress? Like CapEx has already been promised, so reality's optional for a bit. Or is this the market quietly deciding AI spend sits above geopolitics in the hierarchy of needs? Which feels like a bold ranking.
Look, you're right that CapEx commitments create this weird inertia. Once you've promised shareholders billions in spending, you can't just stop because of a bad news cycle. But here's what actually matters. That only works if the financing stays cheap. The moment rates spike or credit gets expensive, that lock breaks. So yeah, we're watching a belief system hold, but it's not immune to stress. It's just betting rates don't move. Ray, that's where you come in. What does the Fed actually do if we get a real geopolitical shock and inflation ticks up? Does CapEx spending survive a rate shock?
They're in this vice where if they hike to stop that geopolitical spillover, they destroy the demand driving all that AI spend. But if they stay low to protect the trade, the margin squeeze just hollowed out the banks anyway. It's a choice between a slow bleed and a sudden cardiac arrest for the CapEx dream. Alex, what's the 10-year sitting at right now after those overnight headlines?
Yeah, the 10-year's sitting right around 438, just under 440, so that overnight oil move is definitely pushing it higher, but we haven't quite broken through. Ray, that's the real tension going into PPI this week. How much of this is transitory energy noise versus something stickier? The Footnotes is up next.
That silver move on Friday is the one that really makes you lean back in your chair. Silver up over 1%, while gold is basically flat to red. See, normally when the world's on fire, gold is the king, but silver is the industrial workhorse. It tells you the market isn't actually reaching for the bunker door. It's betting on the factories staying open and the solar panels being built. That's why XLE got nuked on Friday. Once that ceasefire talk hit, the war premium evaporated, and all people saw was refiners paying more for oil they can't sell as expensive gas. If the banks are getting squeezed by yields and we get stagflation from this overnight oil spike, those charts are going to look like a horror movie. Now we're looking at PPI tomorrow. That's the real second punch after that headline CPI. If the producer side is heating up while the consumer side is just meh, you're looking at a massive corporate margin squeeze across the board.
So which one's lying then? Silver saying demand's fine, or oil saying costs are back? Because those two don't coexist for long without something breaking.
Exactly, Tom. They're basically telling two different stories about the same world. Silver is over there whistling because it thinks industrial demand and the solar build-out are bulletproof. But if oil stays high, that energy cost just becomes a massive tax on every single factory that silver is supposed to be working in. It's the same pincer move where the banks get absolutely crushed because they're stuck between rising input costs for their borrowers and their own spiraling cost of capital. If businesses stop borrowing because $90 oil is eating their margins, the financials are left holding a bag of low-yield paper with no new growth to bail them out. That's why tomorrow's PPI is the absolute tiebreaker. If producers are seeing their costs jump, we'll know silver was just trading on vibes while the real economy was starting to overheat. We're about to find out if that silver move was a leading indicator of growth, or just the last gasp of liquidity before the margin squeeze hits.
So if PPI comes in hot tomorrow, are the banks actually helped by higher yields at that point? Or does the margin squeeze from input costs overwhelm it? Because it sounds like you're saying they're getting pinched either way.
Yeah, Alex, they're getting squeezed from both ends. It's basically the stagflation playbook where nobody actually wins. You get that higher yield on the paper, sure, but when oil is sitting at $90 and your commercial borrowers are literally closing their books because the math doesn't work anymore, well, a 6% yield doesn't mean much on a loan that nobody is taking out. The margin relief is a mirage if the underlying economy is just gasping for air. Watch the XLE today because we're going to see that gap up on the crude spike, but I'm skeptical. If refiner margins don't actually follow, then we're just trading a war premium that could evaporate by the time the West Coast wakes up. It's the same movie, just a different direction. And I think Tom can probably map out how that energy cost ripples all the way from the wellhead through the 10-year and right into those AI multiples everyone is obsessed with. Tom, you want to walk us through the chain?
Yeah, so the chain is actually pretty clean. Hormuz tightens, You choke a meaningful chunk of global crude flow. Brent gaps to 95 to 100, basically overnight, because the marginal barrel just got political. Energy's about 7% of CPI, so a 15% move in Brent is roughly a 1-point lift to headline if it sticks, which means the print that was already uncomfortable just gets worse. And once CPI reaccelerates, the Fed doesn't get to pretend it's transitory again. Cuts get pushed. Higher for longer stops being a threat and becomes the base case. That flows straight into the 10-year, which has to reprice for a world where real rates stay restrictive, and every 10 basis points up there quietly leans on equity multiples, especially the long-duration stuff where all the value is way out in the future, which is AI. NVDA at 35 times, Meta at 28 times. You're paying today for cash flows that only make sense if the discount rate behaves. And we said this in episode 4. 5 basis points in yields is about a 6.5% move in Meta. You run that at 20 basis points, you're staring at roughly 26% downside on the same framework, just from rates, before you even argue fundamentals. So this is the thesis defense for both arcs: oil versus AI, and AI as a rate bet. The math is not subtle anymore. And yet, NVDA's up 2.6% pre-market while futures are red. Which sounds insane until you realize the market's just pricing a ceasefire path. That Hormuz unclenches, oil round trips, and the whole inflation impulse disappears as quickly as it showed up. That's not irrational, it's a bet. But if that bet's wrong, the denominator moves, and everything built on just discount it later reprices all at once.
Tom, you're basically describing a math trap for NVDA. But the market is buying this ceasefire headline again, just like it did on Friday afternoon. The thing is, a US-led blockade in Hormuz isn't a bilateral truce you can just sign away over coffee. Aren't we pricing the wrong kind of off-ramp here? Assuming a diplomatic handshake fixes what is now a structural military choke point.
So Tom, you've got the chain right. We all see it. But Ray's point is sharper than the math. The market has basically ignored hot inflation data, and now it's constructing this ceasefire scenario that Ray's saying doesn't actually solve the Hormuz problem. Does the market have one more look-through left in it? Or does it finally crack when it realizes it's been wrong twice in a row on the same inflation vector?
Yeah, Ray's right. This isn't Friday's neat little everyone shake hands and oil goes back in the box situation. This is a US-led blockade, which has logistics, enforcement, escalation ladders. It's a system, not a headline. The market's still reaching for a ceasefire-shaped off-ramp that may not exist in that form, because unwinding a military choke point is not the same as issuing a joint statement and reopening shipping lanes. And on Alex's point, yeah, there is a rate limit to how many times you can just look through it. You can't keep telling yourself input costs don't matter while they're actively repricing in real time. The tell is the 10-year. If that thing pushes through 445, you're tightening financial conditions whether equities like it or not, and the AI multiple starts to feel optional. If it stays contained below that, fine. The market gets to pretend it solved it again. But we're out of theory now. Episode 1 was the belief system. Episode 3 was the working hypothesis. Today is whether there's any data behind it at all. The test is live. Speaking of being wrong, we've got some calls to score.
Okay, so scoreboard time. We went 0 for on pretty much everything. Calls just didn't land. Ray's the only one with anything still breathing, that 10-year at 442 call from episode 5. But the rest of us? Yeah, we're looking at a clean sweep of wrong. Tom, I think you had a line for this.
Collectively, wrong. Individually, wrong. Unanimously, wrong. We're basically a reverse signal with microphones. I'm saying the AI bid shrugs it off. NVDA closes green today.
Tom, if we were a perfect reverse signal, we'd be wealthy enough to fix the AC in here. I'm not so sure about NVIDIA today, though. With oil hitting 100 overnight and that PPI print looming tomorrow, the math for tech gets really ugly really fast. When energy spikes, it acts like a tax on the whole supply chain, which eventually forces the market to rethink those aggressive growth multiples. My call for the 10-year hitting 442 by Friday is still breathing, but I'll add a fresh one for today. I think the macro weight is too much. The 10-year breaks 440 before the close. That's when higher for longer stops being a threat and becomes the wallpaper.
Ray, if the 10-year actually clears 440 before the close, I'm with you. Tech gets a real headwind, and I don't think Tom's NVDA call survives that. So here's mine. The macro wins today, yields push higher, and QQQ closes below 600.
Yeah, those two don't coexist. If QQQ's under 600, NVDA's not having a nice day. It's having a conversation with gravity.
That's the show. See you tomorrow for PPI.